Welcome. On behalf of the Latin America Reserve Fund, I would like to welcome you all at today's FLAR Dialogue webinar on capital flows and external debt in Latin America, vulnerabilities, strengths, and challenges. Central bank officers view. Once again, the Latin American Reserve Fund and the Development Bank of Latin America are joining efforts in order to hold this seminar. Now I would like to give the floor to Mr. Jose Dario Uribe, the Executive President of FLAR. You have the floor, Mr. Uribe. Thank you very much and welcome to this seminar. Good morning or good afternoon. I would like to warmly welcome all authorities and central bank officers from Latin America and Caribbean regions, international representatives, think tank representatives, faculty members, as well as private stakeholders who are joining us today from different parts of the continent and from all over the world, because usually this event is also attended by some participants from Spain. So the Development Bank of Latin America, CAF, and the Latin American Reserve Fund, FLAR, have joined our efforts in order to host these kind of technical fora. For that reason, we intend to contribute to the evaluation of public policies in order to safeguard macroeconomic and financial stability in order to foster development in Latin America and the Caribbean region. At present, FLAR dialogues have gained great momentum across our region. As you know, our region has been particularly hit by COVID-19 from a social and economic perspective. Latin America and the Caribbean region have been the hardest hit regions in the globe. Back in 2020, we witnessed how economic growth took a nosedive in many economies, in addition to many people dying. As a result, tax authorities took some measures increasing public spending according to the circumstances of each country, and they also increased their indebtedness level. Monetary authorities also took steps in order to guarantee the payment system and stabilize financial markets in order to foster economic activity and employment recovery. Therefore, this has posed a number of challenges to macroeconomic recovery in the region over the past months. As a result, we have held several webinars with chief economists and with the financial stability officials from different central banks in the region. There's one aspect that we had not analyzed until now, and which is critical to the good performance of economies looking forward, is access to international financing. Fortunately, up until now, and at least in the case of the countries that are represented here today, financing conditions have remained relatively favorable. However, there are still certain risks and challenges as to their sustainability over time. So we could expect many things to happen going forward, such as, for example, the approach of the Federal Reserve to monetary policies and many other aspects that can affect financing flows. So in order to discuss these topics, we have brought together representatives from Peru, Chile, Colombia, Mexico, who will be represented by top officials. So they will share with us their views and insights as to the recent performance of capital flows and external debt before and during the current crisis. And they will focus on financial vulnerabilities in their respective countries. I have no doubt whatsoever that this will be a highly fruitful dialogue. So I would like to appreciate all keynote speakers for their attendance, and I would also like to welcome you all once again. Thank you. Thank you, Mr. Executive President. Now, I would like to give the floor to Paolo Sanguinetti, who is the Vice President of Knowledge at CAF, for some opening remarks. Mr. Vice President, you have the floor. Thank you, Carlos. Good morning, good afternoon, everybody. Just like Jose, I would like to extend my appreciation to all those attending today and also to all central bank officers for joining us today. I would also like to extend my appreciation to FLAR, Carlos, and Jose in particular for allowing us to collaborate in this initiative, which, well, has been taking place for some time now. I believe that this kind of dialogue fora in such critical moments for the region are very important. And also, today, since we'll be talking about capital flows and external debt, this is no doubt a relevant topic amidst the current crisis. As Jose has just pointed out, the support provided by governments during 2020 in order to keep companies afloat have triggered many deficits and indebtedness levels growing by 10 percentage points. At the beginning, there was a lot of uncertainty, but capitals began to be used as of September, and mainly in the second half of 2020, liquidity increased thanks to the expansionary policies implemented by the central banks of the United States and European countries. Now, the question is to which extent such liquidity will be maintained over time. All the countries represented here today have been able to benefit from such low interest rate financing in order to back up their deficits while financing their debt servicing at low interest rates, coupled by expansive monetary policies implemented by central banks in the region. The question is, how long will this last over time? We believe that this is not going to end in the short term. There are, though, some signals of uncertainty around, for example, with regards to international rates, that may lead to some shocks at some point down the road. But in the short term, we believe that that will not happen, and this gives us some room in order to organize our finance. The pandemic is not over, and I believe that 2021 is going to be just as difficult, even harder than 2020. In many countries in the region, the contagion rate continues to be high. This could also lead to a downturn in the economies. Therefore, countries are facing a twofold challenge in the region. On the one hand, they shouldn't withdraw aid too early because that will not allow translating primary deficits. But on the other hand, we have to cast good signals of tax reconciliation by implementing reforms as to spending quality, taxation, and also by implementing certain fiscal rules and setting up middle-term tax frameworks in order to create credibility. Perhaps this year, the adjustment or the tightening will not be very tough, but in 2022 and 2023 and 2024, we can actually feel the impact. We believe that that could give or allow some tax leeway to countries, which is so much needed at this time. Again, these are hot topics, relevant topics, and I'm sure that we will be discussing some of these issues during this webinar. We will be talking about international financing, the room that is allowed for public policies, and how we can go through 2021, which is also posing many challenges. Once again, I would like to extend my appreciation to FLAR for making this dialogue possible, and also for all those joining us today, and I shall be here in order to contribute to the discussion. Thank you very much. Thank you very much, Mr. Vice President, for your opening remarks. Well, along the lines of these opening remarks, I would also like to say good afternoon, and in some cases also good evening, because we have people following us from Middle East and Asia. Okay, next, Adriana Arriaza, the Director of Macroeconomic Studies at the Development Bank of Latin America, and myself will be the moderators of today's panel that is formed by Mauricio de la Cuba, Head of World Economics at the Central Reserve Bank of Peru. Before, he was the Head of Macroeconomic Analysis at this institution. Miguel Fuentes Diaz is another panelist. He's a Manager of International Analysis at the Central Bank of Chile. He performed different duties within these institutions, such as macroeconomic analysis head or economic analysis. We also have Enrique Montes Uribe, who is the head of the external sector section at the Central Bank of Colombia. And finally, we have Adriana Arriaza, Gerardo Zúñiga Villaseñor, Director of International Affairs at the Central Bank of Mexico, and also Executive Head at the IMF. So during this forum, we will be talking about capital flows and external debt in the region, with a particular focus on the COVID-19 shock and impact on capital flows and external debt. Again, we will be discussing the vulnerabilities, strengths, and challenges from a macroeconomic perspective, and we will also discuss challenges looking forward. So those are the three major topics that we will be discussing. The first and the second round will be moderated by Adriana Arriaza. Now, let me turn to you, Adriana. The floor is yours. Thank you so much, Carlos. Good morning, everybody. Thank you, Jose, Pablo, Carlos. Thank you all for joining us today from different places. We are going to start out the first panel talking about the effects that the current situation had on these four economies in the region and the impact on capital flows. You know that after the financial crisis in 2008 and 2009, there was a lot of liquidity flooding into the countries thanks to some expansionary economic policies. In 2015, the same situation arose in March last year. We also experienced these kind of events in the markets. So we will discuss the impact triggered by all such changes on capital flows and how they affected emerging countries. So let us start with Mauricio so that he can share with us the situation and the experience in Peru. Thank you very much. I would like to thank FLAR and CAF for hosting this event. I hope that you can all hear me all right. The speaker is asking for some assistance in order to show 3 slides on the screen. Okay, in addressing the first question as to the major structural changes that took place in the Peruvian economy, in the first slide, we can see capital flow divided into foreign direct investment and short-term balances. We see the extremes of volatility and the cyclical and anti-cyclical development. During the Asian crisis, we had an important weight on the financing of current accounts and balances. Thereafter, there was a significant shift to direct capital investments, long-term credits, access to international financial markets, and as a result, the country's current account could be financed mainly by using long-term capital over the past decades. The second graph and perhaps this is going to be discussed in the second round of questions, has to do with the strengthening of external debt in Peru with an accumulation of reserves for preventative purposes and in order to tackle any turmoil situations in, well, the current uncertain context of markets. And the third graph, we see something that is also very relevant to Peru that has to do with credit dollarization, which gives some leeway to the central bank in implementing its policy. In the 80s, we had high dollarization, but this has been changing at a 21% rate. And we see how the public debt is now being more denominated in home currency, that is in soles. So these are some of the structural changes we could point out. In the second slide, going back to Adriana's comment, we see what happened to supply, to capital flows in the COVID-19 backdrop. This shows capital flows towards emerging market economies. The black line shows performance of capital flows in the current context, and the blue line shows what happened during the global financial crisis. So there has been a significant drop in capital flows at the beginning, as shown by the black line, when the pandemic broke out, but then at the end of March, after the response by the Fed and quick stimulus packages put in place, the situation changed, and now we see that the impact is much bigger than compared to the global financial crisis, because when Lehman Brothers went bankrupt and when the fiscal package was approved in Congress, I believe that there was a 50-day term going in between at that time. During the GFC, there was a long uncertainty period that also caused capital flows to lag behind for some time, by contrast with the current crisis when the response was much faster. From a balance sheet perspective, central banks' response and the response of developed countries was also different and much more comprehensive. We can see in March that there was a drop in capital flows with a significant uptick afterwards. This is a slide that was part of a presentation at a meeting of the IMF last Tuesday. This applies to equity and to fixed income as well. China always has a significant weight, and this can trigger off some changes in aggregate. Last year, there were therefore capital flows into emerging market economies, but this is normally something that was related to the situation of vaccination in the different countries. Sometimes flows do not come into emerging economies as fast as they should, as we have just seen. But from a supply perspective, capital flows were quite important. Let's go to the third slide, please. Okay, now let's see what happened to demand and current account deficits. In the case of Peru, last year, we projected a current account deficit that actually turned out to be a surplus at the end of the year. So the graph on the left-hand side shows a current account balance that is quite balanced, but as it was mentioned before, there are two different components here. The private sector on the one hand that reported a positive gap due to a drop in consumption and also due to a transfer from the public sector to the private sector, and also due to uncertainty as to the future, and this affecting consumption, of course. And then there is a highly deficit area that was the public sector in 2020, and that's why financing requirements arose. We're talking about a 9% over GDP in 2020, leading to what you see on the right-hand side. That is to say, to a capital increase and international financing. So in 2020, this was mainly used in order to meet financing requirements. Two significant issuances took place in 2020. Another one took place in March this year in the amount of 3 or 4 billion euros, including a 100-year issuance that has enabled us to obtain a yield curve that is quite favorable to asset pricing. We should underscore that this expansion, as it was mentioned before, depends on each economy. So tax or fiscal expansion was possible thanks to prior fiscal discipline. So after bond issuances this year, including external debt, we're talking about 15% over GDP, public debt accounting for 35% of our GDP, which together with that of Chile is the lowest in the region. And if we do not, if we consider assets, we're talking about 23% of public debt. That is to say, if we deduct those assets. So that's how we have been able to finance the public sector, which this year reported some deficits. Thank you very much. That's all. Thank you, Mauricio, for your presentation, and there are some highlights to it. First of all, you drew a comparison with 2008 GFC, when it took some time for capitals to flow back into the region. That was a financial crisis, I have to say, had a different nature, and it affected financial now financial institutions were better prepared. In the case of Latin American countries, international financing needs last year were fewer compared to the previous crisis because of this demand you have just explained. So there are still some flows coming into the region with lower financing requirements, at least in the short term. Let us now talk about Chile. Chile, Miguel, it's your turn. Thank you, Adriana. Good morning, good afternoon, or good evening. Again, thank you for allowing me to participate at such interesting forum. First of all, I would like to start by describing what happened to Chile with regards to international financing. We had quite a significant balance sheet with regards to both assets and liabilities. Last year, we had 153 points in terms of assets exposure. So we see that these positions were quite significant. In the case of Peru, there was a high share of direct Chilean investment in Peru with regards to both liabilities and flows, mainly in the mining sector, as you all know. We should also highlight FDI, or foreign direct investment, in the country. So that shows what happened in Chile with respect to international financing. As to 2020 developments, as Mauricio mentioned, in our case, there was a current account reversal that shifted from 3.7 points over GDP in 2019 to 1.4% of surplus in 2020. Our interpretation is, even though at first sight we might think of lower withdrawals or lower FDI, however, at the bank, we have a different view, and we have a report on this matter that shows that this is due to a significant drop in domestic demand, particularly in consumption, due to current uncertainty. and also due to consumption restrictions as a result of the pandemic lockdown. That has led to a significant downturn in consumption and therefore surplus in current account. If we take into account prices at which the economy could finance itself through international financing, we see that such prices went up depending on the month. But all in all, there were some significant pricing tensions. When analyzing net and gross flows in 2020, we experienced an FDI comparable to that over the past 3 years, and also financing from both the public and the private sector, but to a lower extent. In net terms, that implied an adjustment to the current account. So that was the situation in 2020, and that's where we came from in prior years. Thank you, Miguel, for your insights. No doubt there are some similarities with the situation in Peru when talking about FDI flows that were now much more stable and significant for all these countries. Let us now take a look at the case in Colombia, what happened in Colombia with regards to portfolio flows, because portfolio flows there continue to have a significant weight on international financing. So Enrique, it's your turn now. Thank you, Adriana. Good morning, good afternoon, good evening, everybody, depending on where you are. On behalf of the Central Bank of Colombia, I would like to thank you for allowing me to share with you some insights with regards to the country's capital flows. First of all, I would like to share with you 2 slides. Can you see the slides on the screen? Mr. Montes is asking. Yes, we can. Okay, so once again, I would like to thank both CAF and FLAR for having me. As Miguel and Mauricio said, and now I will talk about what happened in Colombia over the past decades. This graph on the left-hand side shows the evolution of capital flows and also the evolution of international financing requirements and the impact this had on the balance of payments. We can see that this has been continuous and growing in certain times, and other times it went down. This has made it possible to finance the current account deficit in the country. There was also significant economic growth in the country compared to the previous decade and in the first half of the prior one. That's the reason why international investors decided to direct their FDI flows into the country for portfolio flows and also for debt financing. We can compare this to what happened back in the GFC and what happened with international liquidity. This led to a boom. We also took advantage of the increase of prices between 2014 and 2015 in oil and coal prices. This allowed for some increased exchange, and there was also a Colombian peso appreciation thanks to the performance of the private sector. And finally, we have another significant development as a result of the pandemic that you can see here. So in 2020, for example, capital flows, especially those related to direct investment, came down considerably. And many of these flows came to Colombia. This made it possible to pay external debt through this FDI, and it also made it possible to obtain credit in the external markets. In Colombia, we did a number of things in order to take advantage of this back in 2014. Between 2019 and 2020, there were no capital flow reversal situations that should be pointed out, something that actually happened at the end of the 20th century when the Colombian economy experienced a very significant recession. The next graph shows the structure of how capital flows evolved. You can see this on the left-hand side. Here we see FDI inflows and outflows. What happened in the case of FDI inflows? The green bars show FDI flows. This is a significant component to the Colombian economy because that's the main component of our international financing. Back in 2020, this changed to the portfolio capital flows. So Colombia began to report substantial increases in terms of FDI inflows when Colombia became an investment-grade country. And it also kept some positive numbers between 2007 and 2008, and this was also recovered in 2020. On the right-hand side, we can see the orange bars showing international financing that had a particular good development in 2010, 2018, and 2020. In 2020, as a result of financing needs in the Colombian sector in order to address all the repercussions caused by the pandemic. Now let's see what happened to liabilities. Again, green shows FDIs flows, and that is the particular component of external assets for Colombia. Then we have the accumulation of international reserves. Colombia, therefore, is in a good position in order to meet its debt servicing obligations. That's another important element. So these external assets are some of our portfolio investment flows. Here we are talking, for example, about pension funds, the like. So if we include capital flows in the short term, because what we did was the following: 95% of these capital flows can be considered to be long-term for the 2010-2020 period. And the rest correspond to short-term capital flows. So this is what I can share with you by taking a look at this first slide. Thank you, Enrique. No doubt, developments have been quite positive for Colombia because now Colombia has different terms available and therefore can better face vulnerabilities. Okay, let us now take a look at Mexico. Gerardo, it's your turn. Thank you very much, Adriana. Carlos, I would also like to thank CAF and FLAR for having me. Let me provide you with some context about the past 5 years. Let me describe how conditions have changed over that period and how this has affected capital flows. A number of economic policy measures have been taken in different countries after the 2008 and 2009 GFC. As a result, the international financial system was able to withstand the pandemic that broke out in March last year in a context where financial conditions have changed markedly. And this had a particular impact in some systemic economies. So in EMEs, capital flows had a significant uptick this year, not only if we compare this with last year's results when there was a significant economic crunch and there was a lot of unprecedented uncertainty, but also if we compare this with what happened to capital flows in prior years. In fact, in 2021, the largest capital flows were accumulated in EMEs, at least since 2015. If we exclude China, in emerging economies, we can say that flows reached the same levels as in 2008. Therefore, these flows are mainly being directed at these Asian countries. In Mexico, in particular, the behavior was more or less the same as that shown by other EMEs, but with a different capital flow composition. In 2021, we observed a favorable behavior towards fixed income instruments compared to prior years, but with some slowdown since the end of February and beginning of March due to an increase of long-term interest rates in the United States. In the case of flows towards private equity, performance was also a little bit more favorable, even though there was sort of a halt over the past weeks. How do we compare this against 2020 results? Well, Mexico also experienced a significant capital outflow last year, and between the end of March and beginning of April this year, there was a sharp capital flows, especially in the case of fixed income instruments. In the case of private equity instruments, we are talking also about some significant outflows that took place throughout the year, but not as high as in the case of fixed income instruments. So in 2020, the uncertainty associated to the pandemic had a big impact on capital flows performance in February 2020. And as the pandemic was spilling all over, we saw also some impact on the global economy, affecting global financing conditions, to the point that the major central banks also took some unprecedented measures. During the second quarter of 2020, there was a significant economic shrinkage that reduced the economic outlook and also led to a decrease in the price of commodities, mainly in oil prices, which caused emerging economies to, well, benefit from investments in order to export commodities. What could we expect in 2021? Well, there are two categories behind capital flows. On the one hand, global flows, and then home or local flows. In 2020, global factors prevailed over local factors, as you can see. And this somehow explains some of the capital outflows that took place this year. This had a much more positive contribution in the face of better economic projections, despite the fact that we are in highly volatile context. So this context of relatively more stability and with a better economic outlook could lead to greater differentiation within the EMEs. So we see how this is gaining more weight. And for that reason, the domestic economic policy might seek some macroeconomic vulnerabilities in a context where many emerging economies have many financing requirements and where global interest rates could go up. Even though we cannot let aside that other volatility developments might take place, taking into account the rate of vaccination, the dynamics that one could expect in terms of capital flows to EMEs might eventually be more positive than what we could expect. And I thus come to an end of this part of my address. Okay, thank you very much, Gerardo. So we thus come to an end to the first round of questions. So in your opinion, this year there will be a much more constructive position of push factors and pull factors from a recovery perspective, apart from any vulnerabilities that one may expect. Now let us start with the second round of questions in order to assess the vulnerabilities that are associated to the composition of capital flows. Over the past decades, local markets, fixed income markets offered securities denominated in home currency, in the long term, etc. So let's see how or which direction this composition will take, and how capital flows will go to EMEs, and how that could create some vulnerabilities among these economies in their external and internal conditions. So let us now start with Miguel from Chile. I believe that this question is tied to the first round of questions. Capital flows into Chile, and I believe that it was commonplace across the region, was mainly focused on FDI. Up until now, we do not consider this to be a significant source of vulnerability to capital flows into the country. In the case of Chile, by contrast with what has just been mentioned from the Central Bank of Colombia's perspective, we do not expect this to account for a significant vulnerability. As for exchange differences, that has not given rise to any major concerns either, but of course we are not risk-free. We are still experiencing plenty of global volatility. Afterwards, I will talk about the Fed monetary approach to this. But again, going back to the composition of capital flows into the country, this was very closely related to the foreign direct investment. And again, I believe that we should not expect major vulnerabilities in our country. Now, let us talk about risks for the region in general. There is a monetary policy report that mentions that financing conditions, as Pablo mentioned at the beginning, have had an impact on advanced economies. So as far as all these stimulus packages are withdrawn, then the risk appetite for EMEs will change. And this would certainly cause some financial tensions. This might eventually, well, create some issues for some countries. That's at least our view in Chile. Miguel, and in the specific case of Chile, what about the private debt level? Do you think that there's any risk one should expect around that? No. Actually, exchange risks are very, very limited. And our debt levels over GDP in Chile are not significant. However, our international investment abroad is quite significant. So we have increased our numbers both in terms of assets and liabilities. And this shows another important aspect with regards to Chilean external debt. We're talking about capital contributions of subsidiaries to parent companies. So spreads and financial indexes, whether we're talking about external risk and placement rates, and the bond placement spreads have remained more or less at the same levels compared to previous years, but these levels are still significantly low compared to historical levels. Okay, let us now go back to Colombia. Enrique, I believe that in Colombia there was significant appetite in the case of Colombia that became investment grade. How do you think that this financing could entail specific risks for Colombia? Thank you, Adriana, for your question. Let me share again my slide with you. As Miguel has just pointed out, on the left-hand side, you can see Colombia's international investment position. At the closing of 2020, Colombia had a position that accounted for about 2/3 of our GDP. Here, we should highlight our gross national income, or GNI, and also the external net liabilities position. These are long-term capital flows, and this has enabled us to buffer the developments that took place in the past 2 decades. Besides, capital flows are also coming into the country to be allocated to the internal market and also to large companies. Another important component has to do with another type of investment, portfolio investments specifically, that accounts for the figures that you can see on the slide. So on the right-hand side, you see the evolution of external debt balance. What happens in this case? We see that it has increased by nearly 12% year on year. Last year, it accounted for about nearly 55%. If we break this down by sector, the most important component corresponds to the public sector. Almost 60% is held by the public sector, and the 40% corresponds to the private sector. As for the public sector, very quickly, I can say that over the past 10 years, 14% of GDP neared 32% in 2020. This was due to some financing needs by the national government in order to address the fallout of the pandemic. And that's why we see this flexible credit financing now that is aimed at countries that have good macroeconomic conditions and that have a certain inflation rate as well. So international financing has been growing up to nearly 22%. Last year, it grew up to 22%. Almost 2/3 correspond to this element. This is the debt that is held mainly by large corporates and companies that have an international investment component. The balance of debt corresponds to some corporates, and banks use this debt in order to finance foreign trade. So lending entities in Colombia account for 80% of this balance. Here we are talking about corporates and financial institutions, and 20% corresponds to bank debts. In closing, I would like to talk about the cost of financing. In the case of the private sector, there was a downturn trend or a bearish trend both for short-term and long-term finance. At the beginning of 2020, the financing rate was 3.2% approximately. By December, it went back to 2.3%, almost 1 percentage point. In the case of the long term, for the same period, it went from 7.3% down to 5.6%. So we can conclude that the investment position of Colombia vis-a-vis the rest of the world, even though we still have some risk levels, we all the same see that risks are small and capitals are tied to the country, creating wealth and increasing exports. These are mainly debts coming from the issuance of bonds, and these are mainly long-term bonds. Thank you, Enrique. Do you think that this FDI flows into Colombia, and these flows go particularly to the oil sector, do you think that that could give rise to some risky situation? Well, thinking in the medium term, I would say that we do see some risks with regards to coal. In fact, this is a sector that has experienced some crisis due to the energy transition and the global warming situations. As for oil, the Colombian oil company has been shifting towards more environmentally friendly energy production. Okay, thank you, Enrique. Let us now go back to Gerardo from Mexico. Gerardo, could you please elaborate on the outlook on direct investment in Mexico, particularly due to the upsurge in the American economy that we could expect? How do you think that will affect the Mexican economy? In fact, mass fiscal support that we have observed in systemic economies like the United States has resulted in increased economic growth perspectives, especially if we take into account some of the recent announcements made with regards to investment plans around infrastructure building for next year and the years after 2022. So all this has favored the performance of economic cycle sensitive assets, causing capital to flow into Mexico, but with a relatively higher bias towards private equity. And we have seen that over the year. Even though this situation could suggest more stability and resilience of capital flows in the case of Mexico and other EMEs, we should also mention that all these flows are tied to these stimulus packages. As Miguel mentioned, there are some risk factors involved. For example, some monetary stimulus packages, anticipated packages, by the way, and on the other hand, some economic overheating in some countries that could give rise to some volatility in EMEs. In Mexico, up until now, financial markets have behaved in a mixed manner. The Mexican peso has reported volatility and it has been depreciated since December. On the other hand, medium and long-term interest rates have gone up along the same lines of emerging markets. So risks still persist for the Mexican financial sector, and this hinges upon international or global economic conditions, and this therefore might give rise to some volatility. especially if there is some readjustments of portfolios taking into account assets and the risk tied to such assets. Okay, let us now close this round because we are running out of time. So Mauricio, we are going to finish with Peru. Thank you. Yes. There's something that perhaps is not directly related to this, but I think that it's worth mentioning short-term capital flows which have some weight in financing our economies. It should be mentioned that usually these flows happen with high volatility context when the dollar becomes weaker and when commodities do not have a big weight. So that is when we have high capital flows coming into. So there is sort of a clash happening at the same time, and I will refer to this in the last part of my presentation when I mentioned that we need to have international liquidity available. So that's the connection with capital flows and with exchange terms. As for capital flows composition in Peru, the situation in 2021 was similar to that in 2020, with some financial requirements coming mainly from the public sector. There was a bond issuance in March this year. Here I have some data to throw some light at the first question. Public debt is mainly a long-term debt at a fixed rate in 90% of the debt volume with bond issuance. 60% of the debt is already denominated in local currency, and that percentage has been growing over time. Over the past year, there have been some issuances placed on international markets in order to reduce the dollarization ratio, but the ratio remains high. And then the average life of the debt is about 13 years. So this has to do with risks, therefore. So public debt is low and it's beginning to be financed with long-term issues. Talking about the private sector, and as has already been mentioned, in Colombia, there's a significant amount of investment coming into the mining sector, as well as into infrastructure, like in the case of Mexico. So financing in our country will be tied to long-term capital flows. And if we measure this against the current account deficit, we are talking about low aggregate values for 2021 and 2022. Thank you, Mauricio. So in broad lines, based on your insights, due to the composition of international financing coming to the region, risks seem to be limited, at least in the short term. Let me now hand it over to Carlos so that we can start with the following round of questions. Thank you, Adriana. Let us now start looking forward. This is going to be the last round. We have already discussed some components, mainly around risks. We mentioned that one of the elements that has been present over the past crisis has been the quick and huge response of central banks such as the Federal Reserve, and also the fact that current accounts have been adjusted. However, the situation might change in other countries going forward, as we shall discuss in a minute. So risks persist. In early March, there was an increase of sovereign debt spreads in the region. And as a result, we would like to hear from you. What do you think are the main challenges and risks that each of your countries will experience from a macroeconomic perspective? So let me start with Gerardo so that he can share his views from an American perspective. Thank you, Carlos. In fact, long-term interest rates in the United States have climbed significantly, which shows increased trust by investors in the economic outlook. But this could also cause some concern as to inflation rates for stimulus packages in other countries. However, it seems that interest rate growing seems to be tied not so much to concerns about inflation, but to other factors. Therefore, international interest rates have been growing in sound capital flow environments in EMEs, even though there has been a recent slowdown. Therefore, the reasons why there has been this upturn in interest rates is no doubt good news about economic recovery, and we could expect global factors also to exert a positive influence in order to continue favoring FDI flows into emerging markets. However, regardless of the increase in interest rates, the truth is that such movement means that there will be tightening financing conditions for emerging economies that may show vulnerabilities in their economic context, particularly in a background where there are many financing requirements by countries where huge stimulus plans have been put in place in order to tackle the pandemic. Up until now, the stimulus packages implemented by most central banks try to be accommodative. But as we go back to normal, there might be some tightening in financing conditions that we can expect. And to finish, let me make just one final comment with regards to China not joining international global investment indexes. China is starting to play an increasingly more important role, so we could see a shift in EMEs as it happened when China joined the World Trade Organization. So this is something that should be taken into account. What happens now that China is joining the international indexes, that therefore reinforces the reason why we should keep a good macroeconomic framework in place in those countries. And I thus come to an end of my address in today's forum. Thank you very much for such closing remarks, Gerardo. So you are again talking about China's participation in this context, and this will no doubt have an impact on our macroeconomic policies in our countries. Now let me give the floor to Enrique. Along the lines of what Gerardo has just said, I would like to know, what do you think? What do you think that capital flows will remain coming into the region, both in the private and public sector? What do you think this will hinge upon? Thank you very much, Carlos. I have just one more slide to show in order to answer this question, in order to explain how we explain continuous access to international financing, especially by corporates. So we see liquidity in the international market. This has been affected by public health and also by the pace of the economic reactivation. Now, talking about the private sector and particularly about corporates, we have done some exercises based on Colombian corporates' performance. We discovered that Colombian companies could have direct access to international financing on an ongoing basis, provided that they were market leaders in their respective sectors. That is worth noticing because these are companies with good revenue streams that provide them with natural hedges in order to meet all of their debts denominated in foreign currency, and because they are normally engaged in the trade of commodities and other services. On the other hand, these companies must fulfill another requirement, and that is that must be part of these companies should be held by foreign companies. That is to say, foreign companies should have an interest in these companies. This has become a significant source of revenue for Colombia. In the case of Colombia, these corporates account for about 1/3 of the private debt in the country, providing a great deal of reliability on the country. Finally, these companies should also participate somehow in international financial markets on a regular basis. So in order to have access to FDI, it's also necessary to analyze the balance sheets of these companies. We have to see which is the relationship between total equity and assets. The ratio should be about 6%, and that is sufficient for these companies to continue to access international financing. Also, their exchange position is considered. In the case of Colombia, we do this exercise with companies that hold a large portion of their debt in foreign currency. So we consider their exchange exposure in terms of the amount or the volume of their liabilities pegged to a foreign currency. Usually these are export companies that normally issue financial hedges and that have, again, a high component of foreign investment. This is critical for central banks to allow the exchange rate to float freely, taking into account the balance sheets of companies. And finally, the ROA and the ROE should surpass 5% for these companies to continue having access to domestic financing. This shows how companies can continue, therefore, to obtain FDI or international financing. Okay, thank you very much, Enrique, for your participation, because you are contributing a macroeconomic perspective, and you are also pointing to some mismatches that, however, are well covered in the case of Colombia from a balance sheet perspective. Fortunately, we see how the balance sheets of companies have been performing quite positively. These are, of course, elements that we should consider also in the future because it could have an impact on international financing. There's another aspect that we have observed over the past weeks. There has been an increase in sovereign debt spreads. This also has an impact on the private sector. Several analysts have therefore pointed that this could have an effect on EMEs. I would like Mauricio to share his insights in this regard, the challenges that you consider that this will have from the viewpoint of capital flows in the Peruvian economy. Thank you, Carlos. It's quite interesting to see that fund managers in EMEs, that the pandemic is no longer a concern because I believe that the vaccination is taking place steadily. Now they are focusing more on bond issuances or the withdrawal of economic stimulus by the Fed. So that's now their main concern. So it's quite relevant as to which extent the 2013 event compares with the current situation. I would say that this could favor long-term interest rate increases. But then we have another factor. Back in 2013, the U.S. fiscal deficit was 2.5% approximately. This year it will reach 7%. So there are more bonds available, and therefore this could cause an increased withdrawal, and therefore their policy could be a hawkish kind of policy. On the other hand, up until 2014, let's remember that up until that year, they reached up to 4 billion. So once again, we are placing China right in the middle. I'm talking about what happened after the 2013 taper tantrum. On the other hand, we have a firm commitment by the Fed right now. Now they are going to expand their policies even further. They are not going to increase interest rates in the next 2 years. They are going to keep their purchase policy. Back in 2013, Bernanke in May made an announcement that caused a lot of turmoil in the market. Several months afterwards, they began to reduce their purchases. Right now, their commitment, however, is much stronger than back in 2013. So there are always some pros and cons, and this seems like a horoscope. And in closing, there will always be high uncertainty in the markets. And for that reason, the Central Bank of Peru wants to keep significant international financing levels in order to bring uncertainty down or tackle this uncertainty better. This is a unilateral measure that supplements other alternatives provided, for example, by FLAR and other international organizations, not only the Fed. Why is it supplementary? Because a significant difference in reserve accumulation is that it's done for preventative reasons, because it prevents exchange rates to deviate too much from its fundamentals. So it has an inflow and an outflow objective, and this complements the current credit facilities that are offered. Perhaps you know this, Carlos. To which extent multilateral facilities can suffice in a simultaneous demand context? We know that this has helped in certain idiosyncratic situations, but now that we are talking about virtually all economies going through recession and most of them needing public financing, to which extent the fact that all this demand is happening at the same time will call the first line of defense of international reserves to remain significant. So that's all I wanted to share with you from Peru's perspective. Thank you very much, Mauricio. I believe that you are making some significant contribution to this discussion. You're pointing that there's quite a high degree of uncertainty, and in the face of the latest announcement by the Fed, it's better to have good liquidity buffers available and ready. No doubt we're going through a systemic crisis, but also in the face of high liquidity levels at present, we believe that this might change in the future for many reasons, also taking into account exchange conditions. So it's better to continue building good liquidity buffers complementary to international reserves, because that way we'll be able to strengthen our liquidity position by resorting to multilateral organizations. So no doubt this is critical looking forward. All countries here that are so well represented here today are making steady progress in that direction, that is in building good liquidity buffers in order to complement international reserves, like in the case of Chile, and also by having swap lines held with central banks or with the Central Bank of China, as it has just been mentioned. No doubt this is critical in order to be in a good position looking forward. Now I would like to hear, Miguel, what you think about this from the perspective of Chile. What you think are the main challenges with regards to the stability of these flows, both in the private and the public sector? And what challenges will the economic authorities have to tackle? As I mentioned at the beginning of my presentation, We are not totally risk-free. And considering the stimulus packages launched in the United States, they will continue to evolve. That's what we expect. We should also consider interest rates in the US. I remember what happened on January the 5th. After the elections, when the Democrat Party won the majority in the Senate. So this had an impact, and this is good news because we can anticipate that the largest economy in the world will be standing in solid grounds. This also explains all the drivers thrusting financial assets. I believe that the US economy will grow faster. This will have an impact on EMEs, but there is a risk inherent to this. We might expect higher inflation in the United States, triggering off more measures by the Fed. And perhaps that will have a spillover effect on SMEs. We had a monetary policy report that is similar to the economic outlook that was published this week. So the source of this shock is something to be considered. It's important for our economy. Now, talking about how we can keep international financing looking forward, Mauricio said something that is very important. The economy has kept spreads. Spreads have gone up, but they continue at a good level. Our economy, however, is in a more vulnerable position. In Chile, we had built up some reserves after our good economic years. There was also a change in the pension fund scheme in place in the country. That was a decision made by the Congress that helped us to increase our reserves. And there is also increased private debt. At the beginning, the goal was to have sufficient liquidity in order to grapple with the current situation. But now the question is how this will be dealt with in the future. So I thus come to an end of my address. Thank you very much for sharing your insight into such risks. The Chilean economy had to, use some of its savings in order to deal with the current situation. And no doubt the private sector is more vulnerable now to any external developments or fallouts that might occur in the future that requires an ongoing follow-up. Well, unfortunately, we're running out of time. There has been a most fruitful discussion. So thank you. We have discussed different components. I would like to thank Mauricio, Miguel, Enrique, and Gerardo for such wonderful presentations and for all of their insights. We hope we can count on you once again for future webinars. This has been again a very fruitful dialogue. I would also like to thank all those attending this seminar from all over the world. Thank you for following us. Thank you for joining this webinar hosted jointly by CAF and FLAR. And we look forward to meeting you again at the next FLAR Dialogue. Have a nice day. Thank you. Have a nice day. Bye-bye. Thank you, Miguel. Thank you, Mauricio. Enrique. Gerardo. I believe that he has already logged off, I believe.
Acá estaría muy amable.
Luego